Hello, hello, everyone. Brendan is not supposed to be here. I'm Guillaume Lambert. This is Stop Losing, Start Trading, the live trading show that we do multiple times a week. I'm here with Rosalie, aka Crypto Queen. Let's end this music. We're discussing trades, we're discussing markets. We don't do this. It's not a financial advice. This is just for us talking about the markets, how we see it. It's relevant to Panoptic, but also any options protocol. If you want to know about options, this is the place to be. Rosalie started with a meme options trader, a meme trader. Now she's a very experienced options trader. Quite a transformation. How are you doing today, Rosalie?
Good, good. I'm good in New York at Permissionless with some of the Panoptic team this week. So we've been having a lot of meetings and going to a lot of events. It was like 100 degrees yesterday, and we were on the rooftop. It was crazy. But it's been a really eventful week so far, and more events coming later
Is
today.
the vibe bear market, bull market? What type of vibes?
I would say it's definitely more bull market vibes. People are building, people are excited, and seem to have good sentiment at the moment.
Yes. Cool. So this is kind of very again, conferences. There's ETCC next week. I'll be there as well. You'll be there too. Very busy time. It's good to be in person because every once in a while we kind of work without having any feedback. It's good to meet users. Again, if you're at ETCC or permissionless, feel free to reach out. We have a busy day, so we'll try to do the first part, which is the trading portfolio management with intern. Next one is with Brendan. We have some spicy content. We're very excited to see this. So let's me go over the markets quickly. I don't know if it was. Did it start on Monday? Wait, let me see. Was the crash there Monday or not? I think it was, right?
I think on Monday there was a crash and then it had recovered later that day because I remember somebody had said there was a ceasefire and everything, all the prices went back up, but I didn't check.
Trump was not happy that some people broke the ceasefire. I don't know if you saw the clip.
Oh yeah. Oh yeah.
We haven't seen that many presidents swear at foreign countries, but definitely something what is expected nowadays. But yes, the markets were down bad. Some price reversion, nothing kind of was. Anyways, nothing is permanent. It went back up. I think we had a trade which was profitable because we're bearish. We closed it. I think luckily. Not sure if we created a new one, but we had a bullish trade as well. So maybe this one is covered. So yes, somewhat active. Again, this is not nothing. This is like 5, 10%, 10% maybe $200 in a day and back. This is round tripping that we don't see often. ETH has moved back. I think Bitcoin is also much higher, recovered much better. Bitcoin, what do you say? But this is also good. So again, these moves when they're caused by macro, like you feel it more. Sometimes you see these moves without knowing what's underneath. But when we see macro, at least we can understand it a bit better. But yeah, it's nothing that an option trader cannot manage. Let's look at the interns portfolio. This is up, of course, since we've minted, but this is an option portfolio of again 5.5, five markets. Again, that has just a tiny bit of tokens there, but we're creating multiple trades on multiple markets. This is not meant to scare you or the audience. It's just meant to diversify risk a little bit. We're mostly exposed to ETH and tokens, but then the goal is to have more strategies, correlated, maybe uncorrelated events, can lead to something that's a little bit more stable. We have good wins in the let's keep it in cash. Good wins in the ETH BTC ratio. Take your Bitcoin as well. Losing a little bit on ETH/USDC because of that price move, but overall, a Sol trade as well that we created. This is doing okay. So, is there one market, one position you want to look at first? I think we did also mint a new position, but yes.
Yeah, we can start with BTC ETH. It's interesting when talking to users and traders about risk management. I think the sentiment that I've gotten this week so far is people are really not interested in risk management yet. They seem to be gambling and more reckless, and so I'm trying to convince people more why risk management is
I
important.
mean, and to some extent, you have Hyperliquid and GMX before that, and DYDX that kind of create their niche of traders. And someone that comes in and you can do 100x, even 1000x leverage, and you tell them you can get 10x leverage and it's more expensive. It's a different trade. So I can understand that retail focus, those that have been in the weeds trading perps, maybe look at options in a way that is not as obvious. But if you talk about funds, managers, even any portfolio management, you won't go 10x, 100x leveraged unless you're 3 euros capital. But you're not using the perps for speculative. You use it for hedging, or in the case of options, for some more maneuverability. It's not black and white. So this one trade that we have has been printing on EBTC. This is a delta neutral trade. Opened 27 days ago. It's a monthly option, but it's been paying off quite well. It's We can see the delta here. The delta percent is how much exposure we get. 0.01 is extremely small. So this is the old position we had. It's worked for us almost exactly perfectly like we wanted. So we could close this, but we're earning more premium, which is kind of good. But this is the one trade we had. We had a good run. It's good. Maybe we'll keep it on for the next few days. But it's one trade where this was fine. We decided to add another trade. But yes, do you still think we should keep it on, or maybe close it since we're kind of nearing the 1 month expiry? What do you think?
Yeah, I think I would monitor this to see if the spread goes down within a day or two, to see if people close their positions, and maybe we can close it then. Unless they don't, then I think, yeah, we can definitely close this on Friday if they haven't by then.
Yeah, exactly. And I think the large move we've seen earlier this week means that everyone is maybe more on the safe side. So you would expect the price to maybe not move as much, even if there's a different reversal in the Middle East. I'd say that the market is quite resilient. So again, we have two positions open. This is the old one that was created a month ago, working for us. This is the new one that we created, and this was bullish and also trying to optimize fees. Let's see again. This is a day and a half old. What do you say about that, Rosalie?
Yeah, I mean, it went down just a little bit, but I think maybe that's because Bitcoin um, is still recovering a little bit, or Ethereum
Yeah, I mean the
catching up.
yeah, the ratio is down a little bit, meaning that Bitcoin outperforms again, but it's not much. It moved barely fraction of a percent. So being positive, meaning waiting for ETH to recover, is still kind of true. We don't have anything that is moving you on beyond. It's just stayed the same over the past day, and this is but yeah, we're getting paid tiny bit of Bitcoin. Yeah, I'm still confused with these units, but yes, about a tiny bit. Oh, this is like fraction of the asset. But yeah, this is one position that is new. It's gonna work for us. We're getting paid 7% more on that legs, which is good. But yes, there's not much more to do for that.
Hopefully, price will catch up. How's the Solana trade doing?
Yeah, so this was a Rapsol ETH trade. This is a pairs trade. Now you have to think of ETH as being your reference. This was a bit bullish. We think Sol being somewhat on the lower end of where it's been over the past year meant that we probably have more upside to it. If you look, we're near the bottom. So maybe it can go down, but I would say more chance going to go up. That's why we had a bullish trade. Uh, so making money. Yeah. What do you see about? Well, yeah. How would you handle that position?
Yeah, I would leave it open for now too. Hopefully, it'll grow as time goes on and expand the graph a little bit and have us earn more fees. But it did move. It has moved the way we've expected it to. So
Yeah, and we've been earning fees the whole time. The shock we saw on Monday still also increased the volatility, but it's a quite simple trade. And actually, I'm going to go to the market info, which is I want to see the IV. The IV is quite low actually. So the remember, ETH can be very volatile. Solana can be very, very volatile when you count this in USD term. But when you look at the ratio or the pair trade, volatility can compress. So you have kind of a 34%, which is maybe Apple level of volatility, Apple stock, and
Right.
not Tesla or some of these more volatile ones. So it's kind of low-ish. So we should expect to get some yield, but the price should not move as much as ETH on its own. Should not have as much trees as ETH on its own. But still, it's a trade that now is somewhat directional on the price. And if we look at the whole portfolio with the deposits, we're quite bullish. So we do have some sol in the deposit, so we may expect this to also go up in price. But one of those trades where this is a new trade. You cannot do this on Deribit or anywhere else. You cannot have this type of payoff. You cannot be paid consistently with this. So this is the one way that we have uh, Panoptic being this permissionless work for us. Yeah.
Yeah, that looks great. I'm going to a Take Your Bitcoin party tomorrow, so I'll make sure to let them know that I'm good with my Delta neutral
Yeah,
there.
you're still pretty delta neutral. Oh my god, look at this. So again, this is a very, very good trade. It's a monthly trade, and Bitcoin ticker Bitcoin may be more volatile. So typically, we could even have closed it earlier, but now it's back to where it was. But yeah, what do you see here? What's the main 14% up, I guess, on that position? But
This feels like the Eigen trade at the moment, so I'm quite happy with this. I'm sure there'll be some more price action, but I think we could keep it on longer and just kind of watch it grow more.
exactly, and the fact that you're back to where it was, it's fine. But also the fees added to it means that even if we were to leave that range, and it's quite large, it's 20% up or down. And I would demand, anyways, if we're to leave that range, you're still in the green. You still have a positive return because of that. So yeah, we can, this is a different way, but yeah, any way we go, it's still in the green if we leave. So it's actually a very good trade, and yeah, I'll be happy to pay it, to keep it on too as well.
Yes, great. You said we were losing a little bit in the USDCE.
Yes, we did open a new position. We had a position open that was kind of losing, but we'll look into it. And a straddle that is still paying off quite well. Um, but yeah, so let's look at the new position that we created. Oh yeah, I see. No, no, no. Okay, yes, we have new position opened a day ago. What do you notice about this one?
Yeah, so it's moving in the right direction. Somebody has purchased the option that we're selling, so we're getting a quite juicy spread there. But yeah, it hasn't moved yet into the green zone, but
So now I know. So what likely happened is that this is a position that was opened a few weeks ago, and we did make money in terms of the price move. I think we closed it when the price was lower. So we had a larger position. We wanted to close it, but then there was liquidity locked by buyers. And
oh,
the interface works so that you can reduce it to the max. So this is maybe a aggressive way of telling whoever's buying these two positions, hey, get out of here because otherwise I'm going to pay 3x the fees. And this is what they're paying. So that one position now is a decreased in size. So we remove some risk. I think it's pretty good that their size was down maybe like 75%, but because there's some liquidity now, we get paid quite heavily on this. So, and I'm sure if we look at the, yeah, exactly. This is the,
yeah.
we can compare the Uniswap fee to this one. This one, the whole time was 3x. So if you look at the top is Panoptic, it earned $6.6. If the same position was deployed in Uniswap, it would have earned $2.3. So we're really making 3x the fees. The buyers paying us a lot. This is a trade that we want to get out of, but unfortunately, because of the buying, we have to keep it on. But now we have more fees to compensate for that. So uh, yeah, so this is again, whoever's there, look at your portfolio. I would not keep a position on when it's paying 3x. So yeah, make sure you look at it. But yeah, how do you feel about this? This is a lot. adversarial a little bit. It's like PvP. Oh, you buy my option, let me pay you more. So yeah, how do you feel about that process?
Yeah, I mean, I think it's all about like offsetting risks right now. I guess, we can't close this position and maybe we are in the red zone, so we're losing a bit, but that tries to be compensated through fees. Although, yeah, if you're on the other side, definitely I would not want to pay that much more than
3x is a lot. And one thing that if we're extremely stuck, no one wants to get out, they still want to keep their position. What we can do is that we can buy a position, so there's a lot of liquidity right next to it. So again, there's a tiny bit of liquidity here, but there's a lot here. So we can even imagine us buying that one. So if we were moving against the price in the red zone, we can buy a put here to revert that and hedge that position. So again, there's many things to Arsenal. If this needs to be managed now, I would keep it on, earning quite a bit of fees for not a lot of capital at risk. This is fine. And yeah, maybe last one is the net losing. This was a trade that was created when the market seemed a bit more bullish and hopeful. Uh, I think you mentioned that this would be close, but yes, this is a synthetic long. It's moved down. It's a bullish trade. Price went down, losing 70%. This might be seem like a lot. What do you think we should do here?
Yeah, I guess I would close the position now as well. I think the last time I checked, we were losing more. So it has recovered a little bit, but yeah, that looks pretty brutal.
And we earn some fees, not much, because this is buying and selling at the same strike. So we have a funding rate of sorts. This is a perp, so it was slightly positive. Now it's slightly negative. I agree with you. The price could still go up. Unfortunately, we're paying 3x on that leg because someone else maybe has done the gotcha and kind of came in and swapped their size to make it pay. So yes, I would also agree. Even though we're bullish, we could recreate the same payoff with a different strike, or not even kind of have this bullish component and kind of ride the other positions we have on. So yes, I would also say
Yeah,
let's close this.
definitely.
I think that's it. So again, yeah, we will probably end this here. Friday, we'll see what the market's moving. Now I'm still a bit bullish. I would imagine. Yeah, I also sold a put at the bottom of the and it went in the money, which is fine. 2 days type of trade, so this is good. I would expect that as people kind of see this, you could be delta neutral, but it pays sometimes to be a bit more directional when you see kind of the market being oversold or overbought. So yeah, overall, now we're a bit neutral on that trade, which is where the bulk of our position is. But then this one will be stop being long and bullish, but rather a bit more neutral overall. But yeah, I
That
think that's
sounds
it.
good to me. I think overall the portfolio looks good since we have different markets and we're diversifying. You win sometimes and you lose sometimes. That's okay.
And it the more we even try to manage, I'd say sometimes we overthink things. So Bitcoin, ticker Bitcoin, haven't looked at it because the price, even though it moved, it went back. Big payout. Same thing with Eigen. Um, this one here, BTC USDC. It's also quite like passive. We don't do much. We don't have a lot of liquidity, but these two are still earning. Mostly on the yeah, fees. Actually, this one is neutral. This one is a little bit directional, but yeah, this is another one. We have ETH, BTC USDC also working for us. So, but yeah, we haven't had BTC is so slow moving. We haven't had the
That's
need to manage
true.
it. Yeah,
No new all-time highs yet, but I'm sure they'll come soon.
very very soon, hopefully. All right, so I think that's it. So again, the management is that we close the positions that don't look like it's working for us. Those that make money, we can keep them on. But yeah, this is just kind of how we manage a portfolio. Again, we have to do this once every 2 days. It's fine. You don't even need to do it 24/7. So this is good. Let's bring in Brendan for second half of the show, which is the options hour. But yeah, enjoy the rest of Permissionless, Rosalie. And yeah, if you're in the audience and in New York, reach
Come
out.
say
And yeah,
hi. Yes.
for sure. All
Great.
right. Bye bye.
Bye.
Awesome. Well, this is Options Hour. Welcome to the second segment of the show. And we'll be covering some hot topics in the news and crypto and options, and also a recent post by Guillaume Lambert about loss versus rebalancing that kind of got some people talking on Twitter, I guess, is the nice way to say it. So, how are you doing though, Guillaume? How's
Good.
Wednesday?
Yeah, it's Wednesday. Very hot. Again, it feels like we talk about the weather every
Oh,
time. But yes, very hot, but it's fine. The market is good. As I said, I'm happy with that trade where I sold puts at the bottom of that dip. And then it paid off, which is great. Which is even on crypto Twitter, people say, "Oh, selling options and that losing game." If you do it mechanically, and if you do it like almost ribbon style, you do it whatever the conditions, whatever the market price, you do the same thing over and over. There's no edge there. Maybe you can earn some like risk-free rate, but if you do the same thing with no further thought, there's no extra income. But if you kind of maybe capitalize on some of these moves, it's like not guaranteed, but sometimes there's like uh, it pays to increase your size in the right time, decrease your size. If you remember on Friday last week, I said I'm feeling a bit skittish. I'm going to decrease my size too. So again, you have to play by like not just mechanically doing everything. Even though the management is straightforward, you just have to also kind of use your judgment every once in a while. And this is where the trading, yeah, art of trading is coming in. You just see patterns, you understand it. But yeah, sizing probably is probably the best way to kind of do this and capitalize on these moves.
yeah, well, very interesting. I'm sure we'll see some more of the portfolio on Friday as well and see what happens there. Wanted to jump to some of the recent news. So first, featuring this wonderful tweet by, I don't know how to pronounce this name. Maybe it's Polt, but the FHFA new director of federal housing nominated by the current president of the U.S. So yeah, maybe you're familiar with these mortgage rules in the U.S. that we have. You can't really count a lot of your cryptocurrency holdings for really any mortgage, and then when you sell your crypto, you can't count it for like 90 days or something like that. Is what I experienced at least in the recent years.
Yeah,
So we have some kind of bullish news coming out of a different agency this time.
yeah. I mean, they asked for. We purchased a house about a year ago too, but yeah, they asked for all your 401k investments, and I knew ahead of time that again, Ether on a cold storage did not make any sense, so I divested some of it.
Yeah.
But it's true, I did not know about this 90 days, so we had to kind of. I think we were fine with the holdings and the cash, but they did not like that we had money coming in from Coinbase or whatnot without being explained. And then again, word of advice. I don't know if that's what your mortgage agent told you, but they only look at 3 months worth of bank statements. So if you do it 3 months before and keep it there, then
Yep.
it's fine. So they don't even need to know where that cash came in when the first statement came in.
That's right.
It could have been the day before or 10 years before. They don't care. So that's one thing.
Yeah,
You
they're
can do
not
it.
counting on the fact that like SBF might pull back your money 10 months later. But if it's 3 months, that's their gauge of we're okay with really anything, not just
It's
crypto.
interesting. There's a typo in the
Oh,
tweet too, but
is this supposed to be of? That's how you know it's real and not AI.
the
No.
guy, yeah. So again, I think it's a without saying that it's a professional treatment. It's just bringing crypto to the same level of your stocks as your bonds, whatever you have in Treasury Direct. It counts towards your mortgage now. As you said, crypto does not. And I'm sure it's not going to be like shitcoin X that is kind of paired in a Unity 2 pool and it's worth billions of dollars. But if it's like the stables, like the even stable coins, I'm sure it was not counting, but stable coins, BDC, so all of this should probably count.
Yeah, it's interesting how you'd prove. I don't know if they're talking about on-chain holdings at this point, because even just like converted to USD back in your bank account is already a problem. But on-chain holdings, you'd have to prove that you own this wallet, and that could get complicated for any mortgage people. I don't think they want to
Oh my god, yes, that's
do
true.
that out. But it's funny because I just saw there's a comment from Michael Saylor shilling his new product. with a response. Thank you. We'll review
We touch.
So we do have a Michael Saylor pillow that we are giving out for our trading competition this month, and it ends in 5 days. I guess I'll just
Yeah, the pillow is on volume, so even if you start now, but you can be very actively trading and get to the top of that leaderboard. So yes, it's not uh, hopeless for you if you really want to have that microcellular pillow.
That's right. This little JPEG image that we're showing here, that's what we're talking about. So join the contest. Ends in 5 days, not too late. We'll also have details on another competition coming up in July. It might not be exactly July 1st, but it will be coming up this next month. So stay tuned for that. Another announcement in the news here, a very interesting product from our friends at Volmex and Gains. So Volmex does this awesome implied volatility index where they kind of track 30-day, I think 30-day expiries and the basically the volatility that the market is predicting for Bitcoin and Ethereum going forward. So there's these two indexes, and now Gains has announced this perps product where you can trade perps on the volatility. So what are your thoughts on perps on volatility indexes, Guillaume?
Yeah, when I trade in TradFi, once in a while I use those. I think the when you're setting options, you are inherently short volatility, meaning that if it's a TradFi option, you get paid. You want to buy it back. You get paid by selling. You want to buy it back at lower price. Time helps, but also volatility collapsing helps. But if the volatility expands, goes the wrong way, then you're kind of double hurt because you now have to buy it back more than it is. And typically, if it goes in the money as well, you have to pay for the intrinsic. So what I would do sometimes is not trade the VIX, but rather the volatility futures slash VX or VXM, which is a bit smaller. But this is a hedging. This is another way to maybe shoulder the cost of volatility expanding will wreck you in ways that you don't cannot maybe manage if you do like passive, not passive, but retail level investment. This is just a different way to hedge, and I would not trade the perps for speculation, but rather for again hedging your volatility exposure.
Okay, so how would this work with LPing, for example? So if you're LP, you're kind of short volatility. So would you buy a perp on the ETH?
Yeah, exactly. So you benefit from the perp not move the from volatility not moving much and the price not moving much. If there's a huge spike, probably means price went down. You are out of range, earn zero. But yes, if you buy some of that volatility index, then yes, you have some level of hedging, compensation, risk management on that front. And if the volatility keeps going down, it's fine. You may lose on that perps investment, but the price is going to be in range. You may have less returns, but the more likely is that you'll still be in range. So there's like still revenues coming in. What you want to hedge is being whiplash, out of range, earn nothing, stuck with the kind of delta one position. But now with that type of index, you have profits on the other side that kind of offset that.
Very interesting. And we always have to make these disclaimers, but nothing we say here is financial advice. So question, as far as you mentioned the comparison in TradFi, I think with VIX futures or volatility futures. So why not trade these directly? Like what's the trade-off or difference between doing these perps on the volatility indexes versus just trading the options directly?
Oh, it's a little bit easier instrument to manage. Again, the if you trade we mean trading options as a way to hedge your other options.
Sure, hedging options or just getting volatility exposure.
Yeah, that's
But
right.
this
So
seems like a more direct way to get volatility exposure. So why doesn't everyone just trade directly on volatility exposure? Or like how does the futures market on volatility compare to just the options market?
yeah, I think same way that trading the perp on the underlying versus options, it's different payoff, different risk profile. If you trade the volatility itself, just as speculative, you have to be directionally right. If the volatility goes down, you can lose quite a bit. So it's just as a trading instrument, it's maybe has a bit more risk than an option. If you want to be benefiting from volatility expansion changing. With an option, you're earning fees, which is the constant stream, and then you have to manage your exposure, which is a different way. But you have a different kind of knob to turn, which is not just, oh, I'm going to sell because the volatility went down and I'm losing, but rather I can add positions, remove positions, and some extent the coupling between volatility and price is 100% separate for the perps and the EVIV perps, I guess. Whereas if you have the options, you have the two that can work together in a way. Again, long-winded story. I'd say both have advantages, but perps are a lot more directional, a lot more binary, a lot more risky, in my opinion, if you're wrong. Whereas options allows you to still manage your position, still be alive again even if you're wrong.
It's like the pro versus the retail. I don't know. The pro versus the plus version gives you more knobs. It might be a bit more complicated, but if you
and do you know what is Gains Network? Which chain are they on actually? Because I might even look at this personally.
That's a good question. We should see. If anyone knows, let us know.
Don't tell me it's their own chain, but yeah, if it's
it looks like
it's on base actually.
Base.
On base.
They may have moved before.
There's Arbitrum and they're on Arbitrum, which is great.
Ape Chain too. Sepolia, if you want to practice.
So they have a bunch. I guess the EVIV is newer. Yes.
So I'm sharing here the UI of G Trade, not sponsored. We got BVIV. We also got EVIV here, both new perps markets on volatility. So really fun to see. Not sure how much liquidity there is. It'd be nice to see. It's probably somewhere, but open interest, I guess, here.
But again, now there's no way to trade that curve. Again, if you do it with in TradFi, there's VIX or the VIX futures, but yes, now it's just a new way. And again, the more opportunities. I'm not going to say it's better or worse. It's just different, and it's like a unique trade. I'm really happy about like Volmex and having this listed.
Yes, we're great friends with Volmex, so this is great to see new products in the space, new interest in volatility. Also wanted to check. Yeah, so if you see, this is Volmex's index, so they just track this in a very structured manner so that they get good outputs, right? And so they have this volatility index. They describe how it's done below with the 30 days. And then this perps tracks that as the underlying. Interesting to see, though, how this might differ from something like Deribit index. If we see here, same direction, but
you can't trade this. Yeah, it's even the in a weird way. There's a feedback loop too. You can trade the VIX in TradFi, hedge with the underlying. Like it has a direct impact even sometimes to the price. So yeah, more trading venues, more trade. It's not Volga like we see with Nathan yesterday, but yeah, the more opportunities for trading, the better the market will behave, I guess.
Well, great. Let's jump to the topic of the hour. So we have some very exciting engagement here about the LVR. So very common topic. I think most of the LPs on this show have heard of impermanent loss and are very familiar with that, where the price moves, and if it comes back, you're good. But if the price moves a lot, then you would have made more if you hadn't been LPing and instead been just holding the underlying tokens. But here we have a different kind of metric that's proposed by a lot of researchers. LVR. So why don't you give us a little bit of background about what LVR is and about this post here on Twitter?
Yes. So again, the topic is what I have issues with. Researchers, everyone is doing a great job. It's a unique research topic. So again, I don't want to diminish any of the work, but I feel like it's gotten a lot of attention. And as a retail trader myself, and as most retail trader probably see, it's maybe a problem too big to solve in a way. So LVR is saying, all right, you on Uniswap, you are executing what a market making firm should be doing. You provide liquidity, you provide prices. So each minute, each trade, each block has to be optimal the way that HFT market making is doing. Otherwise, you're losing and bleeding out. And the simplest way is that if you're providing liquidity and the price changes on Binance or a centralized exchange and the price in the pool is something else, the view of LVR is that that discrepancy is your loss because someone else will trade, someone else will move the price. The arbitrageurs will make tiny bit of money because they buy on spot, sell on Uniswap or vice versa. So each one of these price moves that is somewhat linked to a centralized exchange is a losing trade for you as an LP. And the rebalancing is that instead of doing an LP, you could be rebalancing your portfolio, doing all of this yourself. You could manage an inventory and doing this every second of every day. And now you'll be zero, perfect. Anything that's below that threshold of HFT, Citadel level, Jane Street, Optiver, whatnot, of activity and sophistication means that you bleed millions. And that's kind of the framing which, again, if you see the AMM landscape this way, it's fine, but it's just pushes everyone out and says, no, we have to have the same HFT trading firms doing this because they have solved this problem in TradFi. We have an AMM, which is weird, but if we apply that same concept, it could be solved, not by you guys, but the ones on top. And that's the as I said, the framing seems a bit off because it's removing actors saying you don't even know what you're doing unless you're HFT level, and that's kind of the part of that origin story of that.
I see. Thanks for explaining. But aren't LPs on Uniswap or Curve or other protocols, aren't they market makers? Because it's in the name, AMM, automated market making. Oh, hello. We have a guest of the show here. Very fun. So I think you're muted, but very, very nice surprise visit.
Sorry, yeah. Sorry, my son wants to be on TV. Sorry about that.
So yeah, but so basically we have this nice tweet here talking about LVR, so loss versus rebalancing, as we mentioned. Yes. This is kind of the research framework that a lot of people are comparing LP revenue or losses to. And so, as you said, that you can, if you're not up to par at the level of these market makers that are rebalancing, that are getting the best prices, that are quoting the best prices, anything worse than that is considered a loss versus those professionals.
So I have a flashback of that, like BBC World during COVID. I don't know if you remember, but the baby came in the background.
So they're talking about like something very, very serious.
Yes, and then the
politics
kid comes in. All right. Yeah, so you said AMM, market making. You should be an LP. You should think about market making, right? So that's kind of the framing that you think about. And again, without going into my view, but it's probably fine to think of LPs as market makers. But because there's a smart contract, because there's no order book, because there's less control in a way, you cannot expect the same level of activity as a market maker. Again, a market maker has to manage the chain 24/7. The toxic flow, which is one of the topic, is if you do a bad job, even for 1 nanosecond, you can lose a lot of money. You have to be on top. You have a bid ask. The price moves. Basically, you want to get no fill. You have to adjust and follow the price. And any fill has to be beneficial for you. And if it's toxic flow, it means that, yes, you may be filling, but it's actually the wrong price, but you're not on top. So that is a extremely important component of HFT trading, extremely important component of how to be successful. And the fact that you can manage the bid ask over time is basically what a market maker has to do. The fact that you cannot do any of it in AMMs means that you should not be expected to do the same level of management, for one, but also maybe it's not maybe market making. There's a different market maker. And again, the automated, maybe the pool is the one market making, and then you're just a different actor, different player that's not market making. The pool is doing it for you. You're just LP, liquidity provider, doing something else besides the market making.
Okay, well, so if LPs are a little bit different than market makers here, so what is the framework that you are proposing that LPs should be using if it's not this comparison to these more professional, cutthroat market makers.
Yeah. And this is again coming from my own LPing. When I was doing LPing, I had to know basically how much tax do I have to pay, whether I made money or not. And that was kind of the origin story. But you buy into an instrument. When I say buy, is that you have some tokens, you give them away, you buy them, you buy this Uniswap NFT, or it could be an ERC20 V2, but you buy this NFT with your tokens. Now you're owner of a token. You don't have this the funds, the tokens in your account. So even that like impermanent loss, you're not also comparing to what if I did not buy, what if I did not LP. It's all right. I'm gonna spend some tokens, some ETH, some USDC to buy this instrument, and that's the first transaction. The next is, do I make money? How is this instrument priced? Do I whatever happens is this kind of outside of my control, but I bought into an instrument that moves. By the time I leave this instrument, I want to get making money. So the sell side, which is I sell back this instrument, get some token back, is the end of the transaction. The middle part is not in my control, not something I can control because my coins are gone. I bought something, it's home. I cannot return it to the store till I go there. That's the thing that you have to now do away for this. The price moves, you earn some fees in the position, you lose maybe because of the price move. This is gamma risk. But by the time you close this position is the next part. It's not necessarily you actively market making, you just buy into an instrument, you wait for a little bit, hope that the conditions work for you. You can hedge this. You can do all of the same kind of Greeks level management you do for any instrument. But it's when you close it that you realize that profit or not.
Okay, so when you say that, you don't see money leaving your wallet as you bleed millions of dollars. So what is the I guess what would the LVR researchers say is that you don't see this because this is an opportunity cost that you would have been making, and so you would have all this extra money in your wallet.
Yeah, yeah,
Is
exactly.
that
So
the way?
maybe and then this framing that you buy something, you spend money to get an instrument, and then that instrument you sell it back to get your money, some money back, is what happens in LP. If you look at market making, you have inventory. All your coins are yours. All your tokens are yours. All your stocks and cash is yours. It's only when there's a trade that there's an exchange. So you're in control of it all the time. And if you don't be subject to toxic flow, you lose your funds. You are now kind of bleeding, meaning that you had some funds that were yours. Bunch of toxic flow happens, you have less funds. Still yours, but you have less because you kind of wasted it. And that is what happens in TradFi. This is what happens in order books. If you look at this view that you buy an instrument, it's gone already. Even though that instrument may not be priced accurately, may not give you enough with fees, it's not bleeding you. It's part of the instrument. You're making maybe at the end of the period, could be a day, could be a month, a year from now. Maybe the value is lower, but it's not necessarily money leaving your own account. It's the value of the position that changed over time.
Okay, yeah, and I think you mentioned that later on, something about how whether it's embedded in the actual instrument or if it's like added on to it, like the loss.
Yeah, I
I
think
don't remember where here.
the sprinkle, like if you start with this assumption, you buy something, you hope that this will behave well enough, and you'll be making money out of it. But if you don't make as much money, it's not because of the bad execution. It's not because a arbitrager was able to kind of go from Binance to Uniswap back to Binance and make money. It's because you did not get paid enough. It's an implied volatility instrument. Again, we're doing options. So at the end of the day, you buy a what looks like a covered call option. You want to sell it back with more. So if it's mispriced, if you don't make enough, it's because the IV, the actual yield source, is not enough, and not necessarily because there's arbitrage. You can imagine if there's a lot of trading, lots of arbitrage opportunities, lots of active trading, you actually make more. The volatility does expand with large price moves, like we saw even last week. Like big king, you make in one day as much as you did in the past week, so you're getting paid, and that I would say is also more significant in terms of high volatility and what maybe high LVR and high toxic flow, because you get paid a lot more because there's a lot more trading. So the framing is that the instrument you're participating into is like an option, covered call. Yes, it's not guaranteed money, but if you you lose less, it's not because arbitragers sold it from you and bled you dry. It's because now the IV is not high. And again, with Panoptic, we have a way to restore that IV. But that's kind of the different framing. The risk of not balancing your order book on a centralized exchange is that you bleed. This is again, the bleed is like really to gamma, really on volatility. The more you try to balance, the more you can lose. But in the case of an LP position, it's a term that exists, but it is the convexity. It is the gamma of that payoff. If you're very, very narrow and out of range, you have zero LVR. If you're very, very wide, you have low LVR, but because that's the curvature. So at the end of the day, it's just the LVR term is what we equate to gamma. I mean, in an option, because this is the concave payoff that you're participating into.
Okay, well, very interesting. So it sounds like you're comparing LP positions to options, because this gamma word that comes up probably isn't as familiar to our LPs. But if you trade options, you've heard of this gamma. So when you say LVR isn't something to avoid, it's just the intrinsic cost or the short gamma of holding the instrument. What exactly do you mean there?
Yeah, I mean the LVR is attaching a loss to this rebalancing or the price arbitrage that happens, right? Premise is that you could be passive LPing and have arbitragers doing the arbitrage for you, or you could be doing the rebalancing yourself, doing all of it off chain, and you will not pay that arbitrage if you want. You will not be paying you will yes, you will do it on your own. You will not have to have someone else do it for you. You have the adjustment to be done for you. It's not a cost. It's a real process that exists. You kind of offset that rebalancing to arbitragers. They pay you a fee for it, but that's kind of the LVR is just a rebalancing part, maybe that is kind of, you could do it on your own on a centralized exchange, or you outsource this to the arbitragers, but it's not necessarily losing you money. It's just bringing the price to where it should be. If there's no arbitragers, the price will be wrong, and you cannot get rid of it in a sense. If you want to get rid of LVR, if you want to get rid of arbitragers, you'll get rid of the whole AMM. There needs to be someone pushing the price around, and they pay you a fee for it. They gain something. They maybe pay even the proposer to get their first trades there. But at the end of the day, they are moving the price to where it should be, turning that fee to you, and that should be what you care about. Whether they make money on your back, or in the case of like the MM pool, they execute at a better price now versus 5 minutes later. It's outside of your worry because you bought into an instrument that is guaranteed to follow the price, and these arbitragers are the ones following that price. So again, it's
Yeah, so I get that you're saying that LPs, really shouldn't be worrying about this so-called theoretical cost, because they're not actually losing the money from their wallets. It's more a comparison. But as far as like the LVR researchers who are on the forefront, they're looking for what's next. If we could redesign the space and not have AMMs in the first place, exactly. Like maybe let's just get rid of AMMs because they're slower, they're less efficient, they have all these issues, right? Compared to centralized exchange. Why can't we just bring order books on chain, or propose some other solution that's even more effective at automating this market making?
Yeah, I mean, if you're a market maker and then you do this on centralized exchanges, you do this again, HFT, you look at AMM and say, what the hell is this? How do I set my beta spread? How do I remove my order? How do I move it? I see the price moving. I want to adjust. None of it can happen in an AMM. And that's kind of the framing. Yes, of course, market makers will want to make everything look like a market making order book because this is what they're used to. This is how they make money, and this is how they can be successful. And that's one aspect. You need this in centralized exchanges. You need this in even perps trading. You need a market making kind of apparatus to make it work. But if you're taking the other side of the US, AMMs are actually pretty neat. No need for market maker deal or agreements. You can launch any tokens. You can make it liquid from day one. Again, Pump.Fund is using kind of AMMs at the background at the end of the day. You have a different way of doing this. And I would say that the future is to not bring more of the order book, but rather push that AMM nest forward. Again, Panoptic, we are deep into the LP side. Again, we get it. It's an option that you're selling. You can push this way, way, way further. Perpetual options, you can do like you can borrow people, you can move liquidity that is stale. You can do a lot on the options and liquidity layer that is truly unique and truly kind of helping you solve the costs or the worries of LPs in a way that doesn't require to break the whole system apart, create off-chain auctions, on-chain settlements, solvers, everything else. That means that you have less of an AMM and more of a typical order book. And yeah, so again, the solvers, they also help with execution. This is great. But the liquidity providers, those that can actually kind of tap into that potential, they need to be served as well. Yeah, like the solution to LVR is that let's get rid of LVR, liquidity providers, liquidity provisioning, and do something else, which is kind of what I also have gripes with.
I see. Well, yes, and you did mention at the end that we have to DeFi the expletive out of this. We don't have sound effects here. So yeah, I guess you made some good points about how AMMs have some disadvantages to CLOBs or central limit order books, but they also have some very strong benefits, and there's a reason why they came about with bootstrapping liquidity into pools. It made everything easy for the big DeFi revolution to happen and people to launch a countless number of tokens on chain, and now we see that maybe culminating in the Pump.Fund. So yeah, what is kind of your vision here for DeFi? Why is the future of DeFi something like AMMs or even building with options on top of AMMs on the LP side, as opposed to maybe what's being proposed here by other LVR researchers with all the solver networks and these more complicated systems?
Yeah, so again, there's a couple of reasons. First one is it has to scale. Whether it's a extremely liquid token like ETH or a token like for DeFi protocol like Uni or Aave or a meme coin, you need one solution that is able to scale across those. AMMs work quite well. If you have to create a solver network for all the pairs, for all the different trades, then you'll be kind of stuck with a few at the top and kind of nothing at the bottom. So scalability, DeFi, permissionless mean that, again, of course you can launch tokens, but you can do it without even having any intermediaries to do the market making. So just making it scalable, the solution has to come from ETH USDC. It has to be applicable to ETH Uni and even ETH Pepe. And if you solve LVR for one big pool, but then leave what you think is a big problem with LVR for like open for everyone else, then it's not going to work. So that's one point. It has to scale, and AMMs allows you to scale without intermediaries. It's still complex, but it's still much easier than having to hire solvers and market makers. And two, that whole argument breaks down when you look at even options protocol. Let's say you say, all right, we've solved spot trading, we've solved perp trading. We allow order books and solvers and all of this to make this very efficient. Market makers come in, yes, they flood the market, everybody's happy, very liquid. If you want to trade options, again, the IBIT options on the ETF, they have, I don't know, 50 strikes, 10 different expiries. Now you would need 2 orders of magnitude more throughput, 2 orders of magnitude more solving, 2 orders of magnitude more of these kind of still small little markets. And if you have one change of one trade, fat finger moves the whole surface out, all of this has to be updated. And the whole thing now means that if you want to do on-chain order books, 1, 2, 3 orders of magnitude more complex, more data, more everything to make it work. Again, TradFi options are huge. They dwarf the volume of spot in terms of notional volume. Lots of contracts traded, lots of activity. They're used for a reason. And then again, this is kind of the benchmark we should face. But because they have so many micro markets, so many expiries, it's quite hard to scale what looks like a single zero-dimensional trading, which is up or down, versus a multi, like two-dimensional expiry and strikes, cannot be solved by order books on chain, whether it's even Solana or kind of even the layer twos, much less on mainnet. There's a limit as to how much you can do. The latency that you see on spot and futures in TradFi are nanoseconds. Even that speed doesn't help you on the options market making side. There's a lot more to it, computationally much more intensive. So just speed, just activity is not what limits adoption of option. Is this kind of hopefully complex computational requirements. Again, two orders of magnitude more. What I see is DeFi allows you to change how spot trading happens, how landing happens, how yields happen, how options happen. Again, you can land with a perpetual loan. You don't have any expiry, no term. You just hold it for as long as you want. You have collateral, so even if you don't pay, we can seed it from you. So that's one easy sell that makes maybe lending strictly better than TradFi. Again, TradFi, they have to look at your holdings. You buy a house, it's leveraged. They have to kind of do lots of background check to make sure you do have access to it. In a DeFi loan, you have the coins. Yes, we give it to you. We don't even ask your name. Same thing with spot. You don't have any like AMMs allow you to list anything. I don't even want to look at the list of tokens on Pump.fund. Some of them are pretty disgusting, but anything can be listed. No intermediaries. No need to strike a deal with market makers to make it work. Very, very seamless. Again, you have yields, you have tokenized staking, restaking, all of that also makes it very easy to trade on that yield basis. Options, the last frontier, will be solved not by doing the order book on chain approach, but rather this embracing the new world of DeFi. And again, with Panoptic, there might be other ways, but we found one interesting link between LP positions and options. So now we have LP positions, spot, lending. We allow some lending in Panoptic, all within the same roof, all within the same ecosystem. A lot more integrated, a lot more fair if you want. You can borrow at the same rate that, again, Wintermute borrows. You don't have to strike a deal there as well. That allows you to now offer this to everyone, but also make it more efficient for any market. Again, in TradFi, you can trade options on SPY, S&P 500, Tesla, Amazon, all of these liquid stocks. But anytime you go outside of that kind of extremely high market valuation, it's hard to trade. Spreads are huge. No one wants to trade. The IBIT options is liquid, but there's like 7 other ETFs. All the options market are horrendous. There's actually a quite, not even the online, but a quite difficult way to scale. So when I say DeFi the shit out of this is that there is a way to do it simpler. Right? Let me tell you about, I don't know if you know about Richard Feynman.
Tell us about Richard Feynman.
He's a physicist. Have you seen Oppenheimer, the movie? Yeah. He's the guy that was in the car looking through the window and said, "Oh yeah, the glass will block UV." He's a physicist. He wasn't working on the Manhattan Project. He was playing bongo in the movie. He had this idea of physics. So physics is like someone looking at a chessboard in the dark. Every once in a while, you see some piece moving. I would say, "Oh, it looks like the pawns can only move one spot." Or maybe no, two when it starts. So you figure out the rules by watching what happens. Sometimes you have en passant, which is that weird cross that the pawns can do, and you just have to rewrite the playbook. But you just look at all the different little things. Oh, the rook does this. The queen. Oh my god, does so many things. So you just look at the chessboard, try to find a meaning out of this. And the more you look, the more light there is. You get better understanding. In physics and science, typically, maybe in physics a bit more, the more you peel back, when you look at chess, there's like lots of rules, somewhat complicated, but it's all kind of self-consistent. When you look at science and physics, the more layers you peel, the more simpler it looks, the more symmetries there is. Oh, electrons and weak particles are the same, and photons and gravitons. All of this becomes unified, standardized, standard model. The more you dig, the simpler it gets in a weird way. It's simple because it's self-contained, but it's different flavors of the same things, as opposed to an order book that a rule book that has all little clauses for each, like the all little clauses for each of these kind of components. It's simpler the more layers you peel back. I feel it's the same thing with DeFi. whether it's spot trading, whether it's options, whether it's lending, you have this unified, almost too elegant way of combining all of them. And AMMs, again, Vitalik popularized it and invented it. It's started as one way, but the more you dig, the more you see, oh, it has links to options that link to lending. You can do all of these trades that you can do that needs normally tons of intermediaries, tons of capital. You can do this in a way that is quite simple. So the maybe what we do at Panoptic is not going to be the end result, but something like this, I'm sure, will be what we see 10, 15, 50, 10, 15, 50, 100 years from now, when capital markets will be on chain. I highly doubt it's going to be more of the same. It's going to be that more liquid, more frictionless system that is simpler, more elegant, more resilient.
Which one do you think an AI would want to trade with?
Same thing. Again, maybe the AI wants to be the market maker. I would say the yeah, I mean, of course, the AMM one. It's predictable. It's rules based. You have a market maker. They have another book. They can increase the spreads. They can do a lot of stuff right before, right after. It's actually quite opaque. When you want to do something that is AI level of certainty, unless the goal is to out trade the market makers, but you want to trade, you don't want to worry about anything else. There's a way to do it on the AMM. You hedge your you hedge how much energy you need to buy to think a little bit more. You trade options on these kind of energy futures. You want this to be without intermediaries. You want this to be with the cryptographic certainty of a smart contract.
And the AI can bootstrap their own pools. They can sell options even if no one's buying them and still make money. So yeah, we'll see. Awesome. Well, I'd love to discuss with you more another time. We are at the past the hour here. So thank you so much for sharing your thoughts on the LVR framework and how it might not be working for LPs, and how the options framework might be a better framework if you're LPing here or deciding to LP or not. But very interesting, and appreciate your post there. And hopefully if people have questions, I think that people have been very lively in that reply section. So yeah, leave your questions there or opinions there, and we can chat it out. I'm sure Guillaume will be interested.
Yeah, exactly. I'll be at ETC too. So if you see me there, let me know your thoughts too. Again, the goal is, I feel like I had to write this because I felt like the LPs, the retail, the little guys, like there's no hope if you try to listen to some of the influencers. So I feel like the it's me restoring some of that hope, maybe.
Yes, that's what we have to look forward to. Well, ECC's next week. We're in permissionless this week. The Panoptic team will be there through the end of the week. So if you're in town, reach out to us on Discord to say hi. Or ECC, I believe. Do we have an event going on that's available for the public?
Yeah, we do, with our good friends at Cantina. So we have a cocktail hour. Weekend post. Yeah, I don't even know when, but yes, sometimes that week.
Post the details.
Yes.
Great. Well, if you're in town in France next week, I think it's next week, then hit us up. I would love to see you at that event, and we'll see you next Friday for the continuation of Stop Losing, Start Trading, and the best and worst traders before the trading contest on base end. So make sure to join in there, app.panoptic.xyz/leaderboard if you want to get some nice prizes.
Yeah. All right. Thank you, guys. See you on Friday.